Hi, and welcome to the CDFM study group as we continue with CDFM Module 2.1, the Defense Budget Process. And we are utilizing the 2013 study guide. So we will pick up on page 2.1.66, Common Obligating Document. So as resource managers and financial managers, we must understand that in order to obligate funds, we must have some form of obligating document. So it's just giving you some examples on 66 of contracts, and it talks about the FAR, the Federal Acquisition Regulation that governs contracts, the MIPR, Military Interdepartmental Documents, or the 448 is that document that we use between DoD agencies or requesting agency and an accepting agency. So on a MIPR, you have two types, direct citation and reimbursable orders. And they may be utilized with a project order or Economy Act order. So make sure you review the MIPR on the bottom of page 66. And then on 67, it tells you the difference between a project order and an Economy Act order. The significant difference, a project, think of a project, sounds more long-term. So a project order is used to order work services from another DoD entity. No deobligation. So at the end of the fiscal year, if you have a project order contract or MIPR, you do not deobligate the remaining funds. On the opposite side, an Economy Act order is the one used intra-government. So it's not just within the Department of Defense. You also have contracts, transactions that are done between other government agencies. So the Economy Act order is what's used for that, interagency. The difference with the interagency, Economy Act, and the DoD project order is that at the end of the fiscal year, if it's an Economy Act order, remaining funds must be deobligated. So that chart at the top of page 2.1.67 is essential to understanding the difference between a project order and an Economy Act. So between the project order and Economy Act, make sure you know which one you deobligate remaining funds. So which one can cross fiscal years. All right, let's take it over to page 2.1.68. So at the top, it talks a little bit more about the deobligation of the Economy Act order, so you can read through that. It has fiscal limitations. Contingent liability. Contingent usually means some verbiage that is written in the contract that says that the contractor would be paid X amount of dollars once a certain amount of work is completed. So there are contingent liabilities for price or quantity increase or other variables that cannot be recorded as valid obligation. So let's say it's a 12-month contract and it has contingent liability. Well, you wouldn't necessarily obligate the funds associated with the contingent liability because they haven't earned it yet. So the original obligation of that contract would be the amount specific to that contract. Then contingent liability amount may be obligated later. So you can read through that on the bottom of page 68 of contingent liabilities under outstanding contract. Page 69 talks about termination of contract. So there are a couple of reasons. You terminate because the contractor cannot fulfill their obligation or contractor default versus termination for convenience of the government. So typically all government contract has a note or verbiage in there that says if the government needs to cancel that contract, they will be able to cancel without any additional penalties. Foreign currency fluctuation. The two foreign currency fluctuation appropriations, which are maintained at the OSD level, were established to eliminate losses or gains to programs caused by fluctuation. So when we deal with overseas and different types of currency, it's just saying that we have to account for, in our funding, we have to account for that foreign currency fluctuation. Sometimes it's more, sometimes it's less. So we're going to look at some reimbursable agreements. We're going to look at the recurring funds, revolving funds. So you can read through, let's see, page 670 through 72, just kind of talks about some reimbursable support, which is more detail into that MIPR, where you pay to do the work and then someone reimburses you for that job. Let's move to the top of page 74, where you talk about reprogramming versus transfer. You need to know the difference. Reprogram within an appropriation account is a shift from one purpose to another purpose within the same appropriation. A transfer, meaning I need to do a funds transfer between two different appropriations. So reprogramming is within the same appropriation, when you're moving funds within the same. Transfer out, different appropriation. Important, because how we move funding, we either reprogram because we need a different type of funding, or we transfer the funds to pay for a particular bill. So the revolving fund is discussed on page 74, 2.1.74. Revolving simply means that the vendor, contractor performs the job, takes their money, perform the job. Once the product is produced, the contractor sells the product to the customer. Customer pays for the item, and the money the customer pays goes back to the contractor to buy more items. So it's a revolving fund concept. So let's look at a couple of things here with revolving. The revolving fund is also known as the Defense Working Capital Fund, the DWCF. Many of the logistical and support organizations operate under the Defense Working Capital Fund. And it's simply what I mentioned before. So that's what the diagram on page 74 that says revolving fund concept, that is what is being discussed there. Is to show how the contractor, the customer needs the item, the order is then placed, the working capital fund support activity has the item in their inventory, they satisfy the order, they sell the goods to the customer, and that continues to be that revolving fund activity. So on page 75, some things you're going to pull out of there as far as the long-term goal for the working capital fund, which is how they work, is to break even. The government is not trying to make a profit, so it's different from a commercial company where they're trying to make a profit. The goal of the government is to break even. So with the revolving funds, DFAS, for example, whenever you send in a travel voucher or something that you need DFAS to handle, there's a cost associated with DFAS doing the job. So DFAS typically will publish, for instance, their pricing at the beginning of the fiscal year. They'll give you their price and what they charge to, let's say, complete your travel inquiry. Then at the end of the year, they may or may not, in our eyes, look like they've gained a profit or a loss. The cost is then adjusted based on how things cost this year to next year, inflation, and all the other aspects of cost associated with adjusting that cost. So sometimes the cost may be up. The next year, you may see the price drops because they must show, the revolving fund must show that they are making every effort not to earn a profit. So In the middle of 75, it says revolving fund activities evolve from two categories. Stock fund, when you have stock fund supply items, or industrial funds, where funds that provide industrial and commercial goods and services, like your Army Depot, those type of entities utilizing that revolving fund concept. They cannot wait until the customer asks for the item to then go make it. So they have to make certain amount of widgets and then have the widgets available for the customer to purchase. So it's supply versus non-supply type item in your stock fund. The last paragraph on page 75, another difference between supply management and non-supply management in the working capital fund activity is the type of assets each holds. For supply management, the major asset is inventory held for resale, while for non-supply management, the major asset is work in progress, work that is partially done for the customers but not yet readily available to be delivered and billed. So two types there, stock fund versus industrial, which is supplies, inventory readily available versus not readily available, work in progress. So you can see on page 76, again, criteria for using the defense working capital fund is listed there. The goal is to break even, and they're not, so we've already discussed that. What else? On page 77, let's see, I got a highlight there. So I'm reading the second to last paragraph under net operating results. While the positions in the working capital funds can be manned by civilian personnel, the military departments assign military personnel to the working capital fund activities to maintain revolving fund expertise in the military ranks. Since positions occupied by military personnel can be performed by civilian personnel, the cost of these services is included in the revolving fund rates at the cost of a civilian, not as a military person. And I'll explain all of this in a minute. The military personnel appropriation is then reimbursed for the military personnel at the civilian rate. So again, MilPers pays for those in uniform. Your O&M dollars pays for civilians. So what this paragraph is saying is that sometimes military members that are paid with MilPer works in the O&M as a civilian. So one appropriation then has to reimburse the other is what it's talking about. So kind of how the funding flow behind the scenes is what it's talking about here. Defense working capital funds management. You can read through revenues and current obligation, apportionment. Apportionment is that topic that we talked about when the flow of funds. OMB apportions money to the services or the agencies. Net operating result we just talked about. Financial goal is to break even and stabilizing the price. So the working capital funds management is they can't throughout the year consistently keep changing their price for the customer. They got to have that stabilized rate, and then the next year they can adjust their pricing. All right, page 79 at the bottom, it mentions OMB, because we've already talked about OMB, Executive Branch Resource Manager, issues the OMB Circular A11 that has instructions on recording refunds. It establishes the procedures in how we record refunds received to the government. So flow of funds on page 80. It talks about once Congress appropriates the money from apportionment, apportionment, all the way to outlay when the funds are removed from the Treasury, what things we can expect. So you can read through the bottom of 80 and over to 81, accounting for canceled authority. We've already talked about some of this stuff because I talked about upward and downward adjustment if the funds are in the expired state and they are expired for 5 years. When they are in the expired state, the only thing we can do are upward and downward adjustments. No new obligation. On the top of page 81, upward adjustments of expired authority, mentioned there again. And it also talks about accounting for canceled authority. So let's read that and see what it talks about. Because remember on when we talked about when the account is canceled or closed, we typically don't have any control. So let's see, I have some highlights on the second paragraph under accounting for canceled authority. The obligation status of a canceled account must be maintained continuously even though no expenditures or collections may be made from that account. So we can't just, all right, well, they didn't get paid in that 5-year, 6-year time frame, I'm just cancel that request. You still have to keep the documentation. In addition, collections authorized or required to be credited to an appropriation account but not received before the account goes into the closed state shall be deposited in the miscellaneous receipt account, collections of receivables from canceled account. So all that is saying is, as I mentioned, when your appropriations enter the closed or canceled state, we lose accountability. So whatever amount of money we calculate that we have when it enters the closed state, those funds, accountability, are returned to the Treasury in the miscellaneous receipt account, which is the collections of receivables. All right, enough of that. Let's go to page 2.1.82, status of and availability of funds. It's essential that you understand the bottom of page 82. And even though it's a chart, it seems real simple, but you got a picture if there are dollar amounts associated with that. So let's look at this. Unapportioned appropriation. So the floor, let me see if I can find the floor of funds. And actually, let's go to page 2.1.85. You see there's an exercise there on the availability of, and you see there are dollar amounts at the top: appropriation, apportionment, allotment, obligation, and outlay. So those are the steps of the funding flow. That's the order. Congress appropriates the money. OMB apportions that funding that goes to DOD, Department of Education, Department of State. Their funds are apportioned to them, same thing, but different terminology. DOD issues allotments to the services, then the rest of us commit, obligate, and then the bills are outlaid out of the Treasury. So you may have to do a practical exercise on these terms. Terms such as, and I'm on the chart at the bottom of page 85, which says computation formula, they're telling you how to calculate it, computed amount, term, and definition. Most likely, all you're going to get are the terms and the dollar amount. And it'll ask you, what is the unapportioned appropriation? The word "on" in front of it tells you that step hasn't happened yet. So you will have to then take whatever your totals are. So for instance, my appropriation amount is 48 million. My apportionment amount is 24, because that's the order they occur. Appropriation, apportionment. And if the question asks for unapportioned, then I know the apportion hadn't happened yet, so unapportioned is the 24 million. So it's the A, 48 million minus the 24 million. Or you can simply take the difference, which is 24 million. So it says a portion, 24 has been apportioned. So how many has not been apportioned? How many is unapportioned? 24, to get back to that total you had at the top of 48. So A minus B will give you your unapportioned amount. The same thing with unallotted. So once you hear unallotted, you know that that dollar amount has not been allotted yet. But you received, like for this example, you received 24 million. So how much is unallotted? You received 24, you've allotted 20.9, 24 minus 20.9 is 3.9 million unallotted, and so forth. So going back to page 82 with those terms, you need to know what the terms are of unapportioned, what that means, unallotted, unobligated, unpaid obligations, paid obligations versus expired appropriation. What's the dollar amount? So don't think you have to calculate for every one, such as going back on page 85, you see the last one. There's no calculation. We didn't have anything. And understand with the exam, you will always have more information than required to answer the test. So you must know what you're talking about, because they will give you a wealth of information. Then you have to pick and choose, pull out the correct data to calculate the problem. And finally, on page 83 and 84, it talks about the non-appropriated funds, NAF funds. And we've heard those terms dealing with our morale and welfare, recreation, your MWR. They use NAF funds. So MWR has three categories of funds that they receive. Quickly, category A for mission sustaining is generally 100% appropriated funds. So if you read on the bottom of 83, category A, and the very last sentence, it says generally 100%, and the APF stands for appropriated funds. So although they're NAF, they also get appropriated funds, or some portions of them. At the top of page 84, you have category B for community support programs. So these are the things that are conducted on the installation to support our troops. So that particular one, category B, has DoD appropriated funds. Standard for category B is a minimum of 65% of the total expenditures. So category A, mission sustaining program, 100%, because we need it for our mission, so we need 100% appropriated funds. Category B, community support, we get at least 65% appropriated funds to support. Category C, revenue generating programs, says that the appropriated fund support for category C is limited. So the revenue generating could be like your hunting on your installation, you pay a fee, fishing license and fishing fees, and all the other activities on the installation that are used to generate revenue are category C type programs. So you review that, you can see that the chart at the top of page 83, category A gets 100% appropriated funds, 0% NAF. Category B, at least 65% appropriated funds, 35% NAF. And category C gets 0 appropriated funds, 100% is revenue generating NAF funds. All right, so let's look at the exercise on page 2.1.86, the case study PPBE in the Pentagon. So they give you a scenario. I'm not going to read through it, but I'm going to go through the questions and see if you can get the answer. So you may want to try to get the answers on your own first before listening to this video and me giving you the answers. and to make sure that you understand it. And then you can go back and look up the page numbers. So let's see what it says. On page 2.1.86, identify the position title of the individual in the Office of the Secretary of Defense who has overall responsibility for the indicated PPBE phase. So this kind of recaps some of the things we've talked about. The planning is the responsibility of the USD policy. Programming is the responsibility of Director of CAPE, DCAPE. The budgeting, and I'll add the execution phase, is the responsibility of the USD Comptroller. Let's see what else. Assuming today is 1 April 2013, the first thing you need to do is stop and say, well, what fiscal year are we in if it's 1 April 2013? Okay, we are in fiscal year 13. Now read the rest of the question. Assuming today is 1 April 2013, which fiscal year of O&M is being executed? And we got lucky that they asked us exactly the question that you needed to answer. So it tells me if today is 1 April 2013, we are in fiscal year 13. Remember, a fiscal year starts 1 October of one year to 30 September of the following year. Let's see the other one. Assuming today is 1 April 2013, which fiscal year of the president's budget is being reviewed by Congress for the purpose of enacting appropriations bill? So with this question, if it's April, well, a budget has to be turned into Congress for that next fiscal year, no later than the first Monday in February. So what it's asking you, if today is 1 April, which fiscal year budget is currently in Congress? And it has to be your fiscal year 14. FY 14 is being done by the first Monday in February of the year that an appropriation is needed by that 1 October. So for that one, it's FY 14. What else? Unless otherwise approved by Congress. When did the president submit that fiscal year budget to Congress? No later than the first Monday in February of 2013. Assuming today is 1 April 20, and I will tell you the reason I'm going through this because a lot of people find difficulty understanding the fiscal year, especially when you go to an older year. If we are in the current fiscal year, it's easy for people to think right away, but the difficulty comes in now is like, okay, why are we talking about 2013? So let's go back to this one. Assuming today is 1 April 2013, we know it's already FY 13. Which fiscal year POM is the service headquarters starting to prepare? So if we're in 2013, we are looking at 13, 14, 15, 16. So you count 3 years, we are doing POM 16, 17, 18, 19, 20. POM 16, 20. So assuming whatever the current fiscal year is, then add 3 more to it. That'll tell you the POM cycle that we're working on. Next question. When the department submits the POM to OSD, again, POM equals programming phase. Programming phase equal Director of CAPE. So I've already answered the question, but let me read it. When the department submits that POM to OSD, which OSD organization will have the lead to review, analyze that submission? The DCAPE, Director of CAPE, Cost Assessment Program Evaluation. Next, assuming today is 1 April 2013, which fiscal year budget estimate submission is the service headquarters starting to prepare? As we said, you start to prepare a budget about 18 to 24 months before that fiscal year. So if it's currently FY13, that means I am starting to prepare the package for FY15. Because FY14 is, we already established, was turned in February 3rd, 2013. So that means I need to be getting ready to turn in the next year, fiscal year 15. When the department submits that best to OSD, which OSD organization will have the lead to review, analyze that submission. The USD comptroller is in charge of the budget, the best, and the execution phase. So USDC. Will another high-level organization be involved with that review analysis process? In the fall review, yes. You have a DOD representative and you have a representative from OMB to go through that budget. So yes. If yes, name that organization, Office of Management and Budget, OMB. And finally, on the bottom of page 86, what is the title of the documentation that OSD will inform the results of the review and analysis of the POM and the BEST submitted by all military departments? That's the Resource Management Decision, the RMD. All right, so make sure that you review this page, because I've seen a lot of students struggle with, okay, if it's fiscal year this year, which POM am I doing? If it's this fiscal year and this date, well, which budget was just turned in the same year, and so forth and so forth. So review those, and I'll see you guys again next time.